Congratulations, guys. You've finally done it. You've decided to go ahead and make a home purchase. But wait a minute, there are a few things that you have to know, and you really do have to do your research before you even decide what lender you're going to go with. Before you decide, is it really a right time to buy? We're going to be breaking down what is a mortgage, guys, and the loan basics when it comes to a mortgage. So by definition, a mortgage is a mortgage loan or a loan between an agreed party and a borrower to buy or refinance a piece of property. Now, in this transaction, guys, the collateral is the home that you're using. Same thing when you get an auto loan, they are using the auto loan as collateral for the loan, which in turn can give you a much better rate, because if you don't pay the mortgage, similar to an automobile, if you do not pay the loan, they have a right to take back the property that you have. But there is a difference between a loan and a mortgage. Now, loan goes out for a lot of different things. We have unsecured loan, we have auto loans. There are a lot of different loans. Now, mortgage, this is where it's different, guys. A mortgage can only be and is only tied to a property. It is a secured loan that is secured by the collateral of the home value itself. So how does a mortgage work, guys? When you get involved with the mortgage process, you have a lender that is going to give you the money up front in a promise to pay back the loan with interest over a set amount of time. Now, you can do mortgages, I believe it is at this point, up to 30 years. However, the longer term that you're going to take out that mortgage for, the higher the rate is going to be for said mortgage. Now, once you pay that mortgage back, that is right, guys, you no longer have an obligation to the lender and you are free with them. Now, the big difference between the mortgage and the other loan is if you fail to pay the mortgage, they will take your home. That is right, guys. There are a lot of legal guidelines that go with this, but the mortgage company itself will take the home. Now, how do you get a mortgage? So getting into the process, guys, getting pre-approved. Now, this is, again, something you really want to look at your financial institutions, because some of them have true pre-approvals. Some of them have a lot of different pre-approvals, or you could get pre-approved for a certain amount depending on the lender's criteria. Then find a house that you want to get and realize you're not really approved, which is the reason why pre-approvals, guys, need to be guaranteed or need to be backed by a financial institution of good standing. Now, for a lot of people, they will go through and they will get pre-approved, and the pre-approval comes in the form of credit score, and it also comes in the form of income. So using those two factors, they will tell you how much you're pre-approved for. For a majority of people, you have to go do your own research, guys, and see what you can afford budget-wise. Now, this is, again, a hurdle that a lot of people do not look at or do not even think. The home price and the price you pay for your mortgage, so your principal and interest, is not going to be the only cost for the home, guys. There is an entire another bucket that comes with a home purchase. When you look at repairs, when you look at, updating, when you look at renovations, when you look at insurance, when you look at property taxes, there are a lot of things that do come with home ownership, including all of the utilities, which, again, home affordability calculator, guys, hop on Google, hop on Bing, whatever you want to. Make sure exactly how much the house is going to cost you versus what you think it's just going to cost you by swinging that monthly mortgage payment. Now, of course, the pre-approval, on other hands, means it verified your financial information and you're good to go when it comes to the verified process. Now, this is where it gets interesting, guys, because this is where you start shopping. For a majority of real estate agents, they will not even talk to you. You can't get in the front door unless you have that pre-approval letter. Because essentially, if I have a pre-approval for, let's say, $500,000, and I'm looking at the $800,000 price range, chances are, again, real estate agents are not going to show you those properties because you cannot even get approved on those properties. Now, with the pre-approvals, guys, you also have to be very, very cautious, because a majority of time, based on income, based on credit score over 30 years, they will pre-approve you for much, much more of a home than you can actually afford, which, again, we've kind of seen where, remember, our 50, 30, 20, things of that nature, guys. You don't want your income to be house poor. That's essentially what they call it. When you're looking at 30, 40, 50% of your income is going straight into the house, it is kind of crazy. Now, guys, also make sure that your real estate agent is going through and being able to show houses in your place. Make sure they have an MLS number when you're looking at different homes, because, again, you have to have, short of being sold by their owner, for sale by owner, a lot of different things go into these. Now, then you get to the point of the final approval, guys. So you made an offer on a place, the offer got accepted. Now you go through, you do your appraisal, you do your inspection, the title company will do all of the title work, all of the paperwork. planning at this stage when you get to the closing that you're usually going to be giving 3% of that purchase price to the selling agent. You're going to be giving 3% of that purchase price to the buying agent. So there are going to be some out-of-pocket expenses. And this is where some of the negotiation can come in. When you're looking, you do have a buyer, you have a seller, you have a seller's agent, you have a buyer's agent, and then you do have the mortgage company that kind of blends this whole family together in trying to get you into that home. Now, closing on the loan, of course, there's a lot of paperwork, guys. And short of going in the military, I have never signed as much paperwork as I did closing on the loan, which means you have a lot because it is usually government backed, might be VA backed. There's a lot of different loans that we're going to look at in just a minute. But overall, there is a ton of paperwork. So who's involved with this process, guys? Like we said, there's a lender. Lender is kind of what puts everything together. You have a borrower, you have a seller. You might also have a cosigner depending on your credit. Now, like we said before, guys, building up your credit, super important in this aspect. You have to have open trade lines. You have to have a positive pay history. You have to have a good credit score. It is going to give you a much better rate, and the chances of getting approved are going to be much, much higher. Now, there are a few different types of mortgages, which again, depending on your situation, you can have the home buying process conforming loans, non-conforming loans, government-backed loans, jumbo loans, non-prime loans. Again, this is something that your financial institution or your lender is going to talk about and really break down. There's FHA loans, which are government insured loans. You have VA loans, you have USDA loans. Again, there's a lot, including those jumbo loans. Jumbo loans are just what it sounds like, guys. They're loans that are $715,000 or higher. Some areas it goes up well over $1 million for those jumbo loans. So how is that interest rate set by the lender? This is something that a lot of people are really playing into a lot right now. We've seen the 2001, the 2002 boom of the refinance. 30-year rates were around 3%. We'll fast forward to today, 30-year rates are around 8%. So how is the interest rate set by the lender? Now, overall, guys, you might think that the interest rates are set by the lender in the mortgage company that you're going with. For a majority of the part, or for most part, that is not true at all, guys. The interest rates are determined really by two big factors. One, current market rates and the level of risk that you provide to that lender. Now, this makes a big difference, guys. Again, if you're bringing money to the table, if you have a high credit score, if you have fewer red flags, if you have a good payment history, where is your debt to income ratios? All of these things are taken into consideration when you do get an interest rate. The market conditions, unfortunately, financial institutions and lenders cannot really change. However, if you're coming with a good solid 5% down payment, if you're coming in with A+ credit, if you're coming in with minimal debt, chances of being approved are pretty much spot on. Now, economic conditions, when the pandemic hit, guys, the Federal Reserve dropped rates to 0, which again really triggered the housing boom that we see. Now, the Fed does not set the mortgage rates, but interest rates really change depending on the Fed's fund rate, but the Fed itself does not set the mortgage rates. Now, also taking into account, like we said, your credit score, your income, and your assets. A lot of this you are going to have to approve because, again, this is a mortgage, guys. This is for a majority of us, the biggest purchase that you are ever going to have is going to be your mortgage, which means to qualify it, there are a lot of different criteria, including credit scores, 580 for the FHA, VAs are 620, same with the conventional loans, again, depending on what you have. Now, there are a few different loans in here. We have fixed rates and we have adjustable rates. Now, a lot of people want a fixed rate, and what we mean by fixed rate is it is a set rate, it is a set term. So if you get a fixed rate, it could be 8% over 30 years. That is your promise to pay back to that lender or that financial institution. Now, the adjustable rates are kind of the interesting one right now because there are some different variations with this. Now, with an adjustable rate mortgage, usually you'll have it for a set term, which it can adjust, it can vary. Some people do have it longer. As we are sitting right now in a climbing rate environment, the adjustable rates, majority of people are staying away from because they are so expensive, or you could actually do an ARM. So an adjustable rate mortgage is kind of the changing. The rate and the interest can change based on the market, which is kind of crazy. Now, ARMs are usually for 3 years, 5 years, 7 years, 10 years. It's kind of a rate within that term that you're going to refinance to a fixed rate. Now, with this, guys, you have to be really careful because let's say you do a 5-year ARM, You get 4 years in, you refinance that 5-year arm back to a 30-year mortgage. Well, now guess what, guys? You've had your mortgage for 34 years, which is kind of crazy, but going back in time and going right back to that 30-year term again, possibly just to get a lower rate. So what is in a mortgage payment? Again, above and beyond just the actual bill, principal, interest, taxes, insurance. That is a lot of buckets that put together, guys. Now, the principal of the house is the actual portion that you're paying on your home. If you're doing a 30-year mortgage, you will notice almost everything up front, because of the price tag of your home, is going to be going to interest. As you continue to pay throughout the years, you will see that every single payment that you make, principal is a little bit more, interest is a little bit lower, because the principal balance or the overall balance of the home is coming down and continues to go down. Taxes and insurance, we have been in our beautiful home for 10 years. Every single year, property taxes have increased, and every single year, homeowners insurance has increased. That is really something that you do have to look forward to, because they do increase. And again, we've been here 10 years. Every single year that we have been here, property taxes have increased. Now, mortgage insurance, this is really something that I want you to avoid. This is also known as MIP or carrying PMI. It is mortgage insurance premiums or private mortgage insurance that you're required to have on a mortgage if you do not have the down payment, which again, there are a lot of different programs, first time buyer programs. There's a lot of different things that you can kind of change, and depending on the amount of money you're bringing to the table, you can get and eliminate mortgage insurance in its entirety. All right, guys, there's a lot going on with the mortgage industry right now. Knowing what a mortgage is, hitting up that mortgage calculator, knowing your payment, and knowing the true cost of the house is really what I want you to focus on. Because if you do, you'll know exactly, without surprises, what you're going to get when you come in there. So guys, let me know in the comments what you guys think about the mortgage, and I'll catch you in the next video.